Okay, I'm sitting down here today with Ben Eick from Nectar Home Loans Hunter, and at the moment, obviously I'm seeing a lot of first home buyers, and some of them can struggle to get that deposit and to get in the market, especially when it's moving so quickly. So I thought we'd talk about guarantor loans today and how they can go about getting one and getting into the property market.
Sure. So a guarantor loan allows the kids to enter the property market using the equity in mum and dad's home to buy their first home. Ideally for a first home buyer, you pretty much need 9%, which is 5% is your genuine savings, and then you need the other 4% pretty much to cover mortgage insurance and legals and things like that. So for a $500,000 home, you need about $45,000 saved up. I've actually got a pretty cool little video if you want to have a look at that around the deposit and the 9% thing. So you can shoot up that link.
Sounds good. So we'll use the magic of video to have a look at that now.
So what I'll do, Ryan, I'll show you the numbers, how it works, and show you how mum and dad, at no cost to them whatsoever. It's only for maybe a 3 or 4 year period you need to use your home for kids to enable to buy a property. Then after that 3 or 4 years, you get the deeds back to your property. So let's show you how it works.
Let's have a look.
Hey guys, Ben Eick from Nectar Home Loans Hunter here. We're just going to talk about the mechanics of a guarantor loan. So that's a loan where parents are using the equity of their property to help their kids get into a first home. Obviously you need a deposit when you buy a first home, and you need pretty much 9% of the purchase price. So for a $500,000 home, the kids have got to save up $45,000, which is no easy task whatsoever. So a family pledge loan is a way where parents can use the equity in their property so the kids don't have to have any deposit at all. This is how the mechanics of it work, how the numbers work. So kids want to buy a home for $500,000. Mum and dad have got a property worth $800,000. They owe $400,000 on their existing property. So how it works, to buy a home for $500,000, you need $500,000, and you need perhaps stamp duty. If they're not first home buyers, they'll need stamp duty. If they are first home buyers, they won't need stamp duty. So how it works is the bank will basically break up this loan into two, behind the scenes if you like, two separate loans. They'll have a loan of $400,000 against the kid's new home, which is 80%. The cool thing about this is you pay no mortgage insurance. So this is another really cool thing about doing a family pledge loan. No mortgage insurance to pay. So we have a $400,000 loan here. Then over here, we have a limited guarantee of 20% against mum and dad's place. Perhaps a stamp duty if they're first home buyers, no stamp duty, but let's just throw it in there in case they have bought a home before. A couple of grand for legal, so that comes to $120,000. So over here on mum and dad's home, mum and dad already owe $400,000. The kids have a limited guarantee loan of $120,000. So in total that comes to $520,000 loaded up against mum and dad's home. The kids are responsible for this loan, and the kids are responsible for this loan. The parents aren't co-borrowers, only the kids' names will be on the title for the property, and only the kids' names will be on the loan itself. The parents will be guarantors. Then what happens down the track, this isn't forever. So what happens down the track is this property price rises in value as the market dictates, and we might do some renovations on the home. So let's just say 3 years' time, this home's now worth $600,000. In the meantime, the kid's been working really hard and they paid down this loan $120,000, it might be down to say $100,000. And this loan as well, they've got over here is down to, let's say, $390,000. So in total, they only owe $490,000 now, which is pretty cool. Yeah. They can then move this $490,000 loan over onto the $600,000 property now is, because we're not quite under 80%, but we're nearly there. $480,000 would have been better for no mortgage insurance, but we can move this loan over. So this loan then disappears. Mum and dad go back to their existing mortgage. It's only for a period of 2 or 3 years, depending on how quickly the property price goes up, what renovations they may do to increase the property price, and how aggressive they are in making these repayments down. So it's a really cheap, easy way. The interest rates for this loan are no more expensive than any other. The cost to get into the loan are no more than any other. Basically, it's set and forget, and within 3 or 4 years' time, we'll come back and we'll have that discussion. Hey, let's get the loan back off the parents' house, and the kids can get into their first home without a deposit and without paying mortgage insurance. It's a really good vehicle if you've got the equity in your home, mum and dad, to help your kids out.
Okay, thanks Ben, that's great. I think that'll give first home buyers or non-first home buyers who need a guarantor all the information they need to get into this very competitive property market at the moment. If you'd like to know more, contact Ben on the details on the screen and he'd be happy to help out. Thanks again, Ben.
You're very welcome, Ryan. So kids, get on the phone to mum and dad, ask a few questions, see if they've willing to do it or got the equity in the home, then give us a call and we'll be only too happy to help.
Cheers, thanks Ben.
Thanks, Ryan.
Cheers.